Oh, hi. Assalamualaikum warahmatullahi wabarakatuh. And a very good morning to our beloved lecturer, Dr. Siti Haliza Asad, and my fellow friends. Before we start our presentation, I want to ask you guys something. Okay, how are you guys now? Is everyone okay now? Or are you all sleepy? Hello, hello, hello. Hello, any answer? Any response? Any response? Ya Allah, I'm so sorry. I forget this is a video recording, not a live. I'm so sorry. Okay. Forget it. Okay, I hope you guys are not sleepy now, and especially during our presentation later, okay? Today, I am Muhammad Aziz bin Syahri Razlan, and my teammates are going to present about conceptual framework, or in more detail, Malaysian conceptual framework. So, allow us to take some of your times to listen our presentation, okay? Okay, so this is our question. Students need to review the Malaysia Conceptual Framework on MASB website. Prepare a 40 minutes presentation and report the important findings from the Malaysia Conceptual Framework. Please also explain the similarities or differences between the Malaysia Conceptual Framework and the IASB framework. So, let's start our presentation by introducing the Malaysian Conceptual Framework for financial reporting. Let's go. Okay, so first of all, why we need a conceptual framework? Why? Okay, as you guys know, financial statements are prepared and presented for both internal and external users by many entities around the world, right? These financial reports are based on estimates, judgments, and models rather than the exact depiction. Therefore, there is the need of conceptual framework in order to establish the concepts that underlie those estimates, judgments, and models. And what is the conceptual framework actually? Conceptual framework is defined as a structured system of interrelated objectives, fundamental characteristics, and concepts which lead to the development of high quality and consistent reporting standards. Consistent reporting standards here refers to Malaysia. It is MFRS, which developed by MASB. But when we are talking about the international standard, it refers to IFRS, which created by IASB. However, the conceptual framework is to prescribe the nature, function, and limits of financial accounting and reporting. So later on, we will discuss about the similarities or differences between Malaysia Conceptual Framework and that IASB framework. Okay, but before that, let's look at the history of Conceptual Framework first. As we learned from previous class, so this is the history of Conceptual Framework. But I summarize it and make it simple. So in April 1989, the framework for preparation and presentation of financial statements, which known as framework, was approved by IASC board, or we call that International Accounting Standard Committee. Next, on July 1989, this framework was published. So, as time goes by, this framework has been used by IASC until April 2001. In April 2001, the IASC has replaced by IASB, which is International Accounting Standard Board. And IASB adopted this framework, and as years goes by, IASB has approved the new version of conceptual framework on September 2010. And lastly, on March 2018, the conceptual framework for financial reporting 2018 was published, and this framework has been used until now. Now, we will look at to the history or background of Malaysian Conceptual Framework for financial reporting. So, this is show that what is exact attempt and effort to develop Malaysian Conceptual Framework. For your information, Malaysian Conceptual Framework for Financial Reporting was actually the IASB Conceptual Framework that was issued by Malaysian use, and the attempt by Malaysia was done by MASB. MASB is a Malaysian Accounting Standard Board, which is the local standard setter in Malaysia. So, in July 1998, the discussion paper 1 that entitled The Framework for Preparation and Presentation of Financial Statements was issued by MASB, and there was actually the attempt to set a foundation for the manner in which financial statements should be prepared and presented. Okay, what happened next? Next, in July 2007, that discussion paper 1 is now been finalized as the MASB Framework for Preparation and Presentation of Financial Statements. Okay, so later on, in November 2011, Malaysian Accounting Standard Board or MASB had issued a new version of Conceptual Framework for Financial Reporting. But Conceptual Framework in 2011 is not yet a complete project. There is some of the chapters were still missing. For your information, now there are altogether 8 chapters in the Conceptual Framework for Financial Reporting, and the one in 2011 was not yet a complete project. Next, in April 2018, the MASB had issued the revised Conceptual Framework for Financial Reporting. This revised Conceptual Framework is called as MASB Conceptual Framework, and it is respectively equivalent to the Conceptual Framework for Financial Reporting that earlier issued by International Accounting Standard Board, IASB, in March 2018. And now, this is the complete project, and it is contain 8 chapters altogether. So, that's all for background of Malaysian Conceptual Framework. Hello guys, we meet again. Okay, now I will briefly explain the objectives of financial reporting. The first objective is to provide useful information to the users of financial reports. The information should be useful from a number of perspectives, such as whether to provide credit to the customer, whether to lend to a borrower, and whether to invest in the business. Okay, for the second objective is to provide information about the cash flows to which an entity is subjected, including the timing and uncertainty of cash flows. This information is critical for determining the liquidity of the business, which in turn can be used to evaluate whether an organization can continue as going concern. Okay, last but not least is to provide liability and economic resources information, or to disclose the obligations and economic resources of an entity. There should be an emphasis on the changes in liability and resources, which can be used to predict future cash flows. Okay, so that's all from me. I will pass to the next presenter. Thank you. Bye-bye.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Amni Putri binti Muhammad Zuki, and I'm going to present the qualitative characteristics of useful financial information. The qualitative characteristics of useful financial information discussed in this chapter identify the types of information most likely to be useful to existing and potential investors, lenders, and other creditors when making decisions about the reporting entity based on information in its financial report. There are 2 fundamental qualitative characteristics, which are relevance and faithful representation. The first one is relevance. Financial information is regarded as relevant if it is capable of influencing the decisions of users. Next one is faithful representation. Financial information must be complete, neutral, and free from error. Next, we have enhancing qualitative characteristics. The enhancing qualitative characteristics are divided into 4 attributes. The first one is comparability. The financial information provided should be possible to compare an entity over time and with similar information about other entities. The second is verifiability. If information can be verified, for example, through an audit, this will provide assurance to the users that it is both credible and reliable. Next, timeliness. Information should be provided to users within a time scale suitable for their decision-making purposes. The last one is understandability. Information should be understandable to those that might want to review and use it.
Assalamualaikum. My name is Nurul Syafiqah Aida and I will present to you the definition, recognition and measurement of the elements in financial statements. Now, let's take a look at the elements of financial statements. The elements of financial statements can be seen through the complete set of financial statements, which are statement of financial position, income statement, statement of changes in equity, statement of cash flow, and noted to financial statements. All these statements build up by 5 key elements, which 3 of it are stated directly in statement of financial position, which are assets, liabilities, and equity, and 2 remaining elements are stated in statement of financial performance, which are revenue and expenses. Let's first take a look at the definition of each element. Assets. As mentioned by MASB in its report about conceptual framework, an asset is a resource controlled by the entity as a result of past events, and from which future economic benefits are expected to flow to the entity. The second one is liabilities. Liabilities is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. The third one is equity. Equity is the residual interest in the assets of the entity after deducting all its liabilities. The fourth one is income. Increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decrease in the liabilities that resulted to the increasement of equity, other than those relating to contributions from equity participants. And the last one is expenses. The expenses is the decreases in assets or increases in liabilities that results in decreases in equity other than those relating to distributions to holders of equity claims. Moving on to the recognition of the elements. The recognition is the process of incorporating in the balance sheet or income statement an item that meets the definition of an element and satisfies the criteria for recognition, which are: the first one is, it is probable that any future economic benefit associated with the item will flow to or from the entity, which means it is referred to the degree of uncertainty that the future economic benefits associated with the item will flow to or from the entity. The assessment of the degree of uncertainty is based on the evidence available when the financial statements are prepared. For example, when it is probable that a receivable owed to an entity will be paid, it is then justifiable to recognize the receivable as an asset. The second one is, the item has a cost or value that can be measured with reliability. It means the use of estimation in cost or value is an essential part of preparing the financial statements, and it does not undermine the reliability of the cost itself. However, when a reasonable estimate cannot be made, the item will not be recognized in the balance sheet nor income statement, and it would be disclosed in the notes, explanatory material, or supplementary schedules. Now, let's take a look at the recognition of each element. For assets, it is recognized when it is probable that the future economic benefits will flow to the entity and the asset has a cost or value that can be measured reliably. An asset is not recognized in the balance sheet when expenditure has been incurred for which it is considered improbable that economic benefits will flow to the entity beyond the current accounting period. Instead, will be recognized as expense in the income statement. The second one is the recognition of liabilities. Liabilities will be recognized in the balance sheet when it is probable that an outflow of resources embodying economic benefits will result from the settlement of a present obligation, and the amount at which the settlement will take place can be measured reliably. The third one is income. Income can be recognized in the income statement when an increase in future economic benefits related to an increase in an asset or a decrease of a liability has arisen that can be measured reliably. The fourth one is the expenses. Expenses can be recognized in the income statement when a decrease in future economic benefits related to a decrease in an asset or an increase of a liability has arisen that can be measured reliably. Expenses are recognized in the income statement on the basis of a direct association between the cost incurred and the earning of specific items of income. Before I pass the next part to our next presenter, let's have a look at the measurement of the elements of financial statements. So, what is measurement? Measurement is the process of determining the monetary amounts at which the elements of the financial statements are to be recognized and carried in the balance sheet and income statement. A number of different measurement bases are employed to different degrees and in varying combinations in financial statements, including historical costs, current costs, realizable or settlement costs, and present value. For historical costs, it is whereas assets are recorded at the amount of cash or cash equivalents paid or the fair value of the consideration given to acquire them at the time of their acquisition, while liabilities are recorded at the amount of proceeds received in exchange for their obligation, or in some circumstances, for example, income taxes, at the amounts of cash or cash equivalents expected to be paid to satisfy the liability in the normal course of business. As for the current cost, assets are carried out at the amount of cash or cash equivalents that would have to be paid if the same or an equivalent asset was acquired currently, and liabilities are carried at the undiscounted amount of cash or cash equivalents that would be required to settle the obligation currently. For realizable or settlement value, assets are carried at the amount of cash or cash equivalents that could currently be obtained by selling the asset in an orderly disposal, while liabilities are carried at their settlement values, that is, the undiscounted amounts of cash or cash equivalents expected to be paid to satisfy the liabilities in the normal course of business. And the fourth one is present value. Assets are carried at the present discounted value of the future net cash inflows that the item is expected to generate in the normal course of business. Liabilities are carried at the present discounted value of the future net cash outflows that are expected to be required to settle the liabilities in the normal course of business. Now, let's move to our next presenter.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nuliana binti Sapu Bahari and I will explain regarding concept of capital.
There are two types of concept of capital. The first one is financial concept and the second one is physical concept. Generally, capital is anything that provides value or benefit to its owner. First, I will explain on financial concept, which capital is measured as invested money or invested purchasing power. Financial capital also is synonym with net asset or equity. Next is physical capital, which capital regarded as productive capacity of the entity based on units of output per day. And physical capital is measured as operating capability. First, I will explain on concept of capital maintenance. First is financial capital maintenance. Profit is earned only if the financial amount of the net assets at the end of the period exceeds the financial amount of net asset at the beginning of the period, after excluding distribution to and contribution from owners during the period. And it can be measured in nominal monetary units or in unit of constant purchasing power. Under physical capital maintenance, profit is earned only if the physical productive capacity of the entity at the end of the period exceeds the physical productive capacity at the beginning of the period, after excluding any distributions from owner during the period. And it can be measured in units of output per day. And finally, the capital maintenance adjustment is the revaluation or restatement of assets and liabilities give rise to increases or decreases in equity. While these increases or decreases meet the definition of income and expenses, they are not included in the income statement under certain concepts of capital maintenance. Instead, these items are included in equity as capital maintenance adjustment or revaluation reserves.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Izzati Hasira binti Haru Anwar, and now I will explain about the similarities between Malaysia and IASB conceptual framework. The first similarity is as a basis for financial reporting. The objective of having financial reporting under both conceptual framework are similar. One of the objectives is to provide useful financial information about the reporting entity to the existing and potential investors, lenders, and other creditors in making decisions. Other than that is to assist the preparers to develop consistent accounting policies when no standard applies to a particular event. Next, the types of financial statement to be prepared. The financial statement that needs to be prepared included balance sheet and income statement. Basic elements consistent in balance sheet are asset, liabilities, and equity, while income and expenses are consistent in income statement. The definition of these elements are same all over the world. The third similarity is convergence rather than adopt. It is said to be convergence rather than adoption because it needs to be localized. The framework needs to be complied with local legislation on financial reporting. The convergence with IFRS brings a lot of advantages to Malaysian companies, which is to provide a better understanding to its existing and potential investors from all over the world. Fourth, the qualitative characteristics of useful financial information applied are identical between Malaysia and ISB. There are two fundamental qualitative characteristics, which are relevance and factful. Other than that, there are also four enhancing qualitative characteristics, which are comparability, verifiability, timeliness, and understandability, which the meaning of those characteristics has been explained earlier. Last but not least, the underlying assumptions for financial reporting are similar for both Malaysia and IASB. It comprises of going concern and accurate accounting assumptions. The financial statement must be prepared on going concern basis. Other than that, the financial statement also needs to be prepared based on accurate accounting. Accrual is the method that records revenue and expenses when they are incurred rather than when the cash is exchanged.
Is everyone okay now? Or are you all sleepy? Hello, hello, hello?